In this video, I'm going to talk about a common basic thing that we do in accounting often that we sometimes take for granted, I think. And it's the topic about reconciliations. So this is one of those things that I consider an important takeaway, even though it's a basic one. So the most common reconciliation that you guys can probably think about right now is the bank reconciliation. But in reality, there's just so many other reconciliations that we're constantly doing that it's worth taking a minute and just kind of thinking about them. And part of the reason why I want to do this video is just to give you a perspective on it that is just so simple and hopefully can help you if you're caught in a situation where you're having a hard time maybe performing a reconciliation. So let's look at the most basic one. The most basic one would be a bank reconciliation where we have information from our general ledger or our accounting system and we're comparing it to information from the bank records, the actual bank itself. And I guess I should rewind a little bit. The whole idea of a reconciliation is one in which you have one set of records. In most, since we're dealing with reconciliations of a business type, we're dealing with a set of records from our company versus the set of records from another company many times. Okay, it doesn't always have to be another company, but most of the times it is a reconciliation that we're doing in that fashion. But here's the idea. We're looking at our number versus somebody else's number, and most of the time those numbers are not going to be equal, and hence the need for a reconciliation. So, for example, in the typical bank account reconciliation, what we do is we take the general ledger balance, ending balance of cash, in other words, whatever we have in our records, and we compare it to the bank account ending balance. So for the sake of conversation, let's call this X, and let's call this one Y. And the reason I'm calling them X and Y is because most of the times they're going to be different. Okay, and then to these things, to the X, we're going to do pluses and minus of reconciling items, and we'll do the same here on this right side to the account. Okay, it doesn't matter whether you put one first or the other, it's just how it is. And then eventually we get to this thing called the adjusted balance. Okay, and I'm going to highlight it here. And the adjusted balance, let's call it value Z. And hopefully when you do your reconciliation, you get balance Z on both sides. And what that means is that you've reconciled the differences. So instead of saying I have X dollars in cash, technically you're going to say, well, the reconciled balance of cash is Z. And it should be the same as what you reconciled over here. And the idea is that even though this is what's on your records in terms of cash, this is what you will have in the short term in your cash balance. And I'll come back to that in a minute. Okay, but this is the main framework of a reconciliation. In this case, a bank reconciliation. Now, what's an easier way to think about these reconciling items? I like to think of it as follows. So let me draw a little bracket here. So instead of thinking it as reconciling items, which they are, I'm just going to call these things the bank did that I have not done. Okay? So notice how simplistic this description is. Anything that the bank did in their records that I have not included in my records are the reconciling items that I have to include here. Now, automatically, you can think of the other side similarly. So on this side, let me move this over here real quick. Bear with me. All right, so here we're going to have things I did on my GL that the bank has not done. again, you can call them, you can call these reconciling items to the bank balance, or you can just simply think of them as things that I did on my GL, any transaction I recorded on my GL that the bank has not recorded. Okay, and if you think about it this way, you're never going to go wrong. It's just that simple, really. Let me add a couple columns here so it all fits. Okay, now you've learned in terms of bank reconciliation, what are the things that the bank does that maybe you haven't done. These could be things like a service fee. In other words, you look at the bank information from the bank statement or online, whatever, and you realize that they subtracted a bank fee, which you have not recorded. So that's something the bank did that you have not done. So that's a service fee that goes in there. So you would have to subtract that service fee. If there's a non-sufficient funds check, okay, you might find out that the bank on the statement says, well, this is a negative now, so you have to subtract it. Or for that matter, it could be a collection of an account from somebody, like a direct amount coming in, okay, like a wire or something that maybe you haven't recorded yet, a wire in of money, etc. So the key, and I think it should be key for you, is try not to get into the habit of memorizing what are the things in there. Okay, it could be, you should know the basic ones, of course, but there's no need to memorize what are the things that are considered reconciling items. The reason you don't need to memorize it is because this could be anything. It could be anything the bank does that you have not done. It's that simple. Now, to the bank balance, what are some of the things that you might have done on your GL that the bank has not done? Well, this could be adding checks, subtracting checks outstanding. Okay, so if you have some checks that you wrote, if you have some checks that you wrote that the bank that have not cleared the bank, then that's something you subtracted in your balance. That's something you did on your GL that the bank has not reflected there. So you'll have to subtract it from here. In that same vein, deposits in transit. So these are deposits you recorded in your X. In other words, that deposit is what gives you X, part of what gives you X. But Y does not reflect that deposit because it hasn't cleared the bank yet. So it's a reconciling item to the bank balance. Okay, and anything else. So I'm just going to put etc. So instead of me thinking of it from the perspective of reconciling items or the specific items, I just think of it as this simple statement right here. In fact, let me change how I'm doing this. I'm going to highlight this yellow because that's really, to me, the thing I want to remember. So let me highlight this in yellow. Let me change this. I'm not going to put a highlight here. Let's put this a different color. And I know it makes no difference, but what color is the reconcile balance? Let's put it green. Hopefully you guys can see that. Okay. So in other words, here's your GL balance in red. Here's the bank balance in blue. They eventually should give you this Z green amount. But the way I remember this is as simple as this highlighted field right here. Things I did on one side that the other side has not done. And again, things that were done on the other side that I haven't done. Now, this is the bank reconciliation, but an example of the bank reconciliation, and it's very common for us to see that. But really, the whole topic of reconciliations is just broad in nature. So I'm going to give you a few others that you got to think about. Okay, in the case of accounts receivable, okay, we have a set of records of sales and receivables from our customers, and sometimes that doesn't jive with customer records. So it's the same setup. This would be your X balance of AR, and this would be your Y balance of AR. And you'll go through this same process that we did right here. Two adjustments here to AR are things the customer has reflected on their customer records that we don't have, and vice versa. And then the adjustments to customer records are whatever we've done that they have not done. And if you do that, you'll get an adjusted balance Z, just like I did right here. Think about accounts payable as well. Okay, accounts payable versus our vendors. Those are reconciliations that we have to do when our records do not match the records of the vendors. Okay, so these are very, all these three I just mentioned, the bank reconciliation, AR, and AP are very similar in how you go about it. Now, think of others that perhaps are less intuitive. And this is, these are always our records. The ones I just mentioned, the first three I just mentioned are our records versus a third party's records. AR is our records. Customer records is a third party. AP versus a third party. Now, think of something like inventory, the GL inventory. So let me just be real clear. Versus a physical count of inventory. Okay, so this is both information from our company internally. This is what's on our GL, our accounting system, and then this is what's on our records from going out there and actually counting our inventory. Again, this is a scenario where you'll have a value X right here, and you have a value Y here. And you can use this setup right here with the highlighted yellow, where you're going to go in there and adjust things that people saw in the physical count that you don't have on your records. And then here, you're going to do the opposite. And again, if you follow this very simple process, then you'll get an adjusted balance of inventory. And it should jive. It should be the Z value. Okay? The other, and we can go on and on with these reconciliations, where they can apply. And I want you to think of them very broadly. And if you think of them with this description right here, then no reconciliation is an issue. The reconciliation is nothing more than whatever the opposite side did that I didn't, I need to adjust it. Okay? And then think of others like intercompany transactions. Some subsidiary A does certain things with subsidiary B. Well, we got to reconcile those two records. And interestingly enough, this also tells us what needs to be done on our accounting system. Anything that you describe like this, anything you say, okay, things the third party, the outside party did that I have not done on my records, that's what needs to be recorded on the accounting system. Okay, so let me say it a different way. This side right here are things you did on your GL. You have it in your accounting system that the bank has not done. So you don't need a journal entry for this. You don't need to record anything here on this side to your accounting system. But on this side, anything that you have not done, but that some other third party has done correctly, then you need to go and do it on your accounting system. So if you define things in this very simplistic manner, then it'll also tell you that this is the stuff that needs to be in your accounting system. That'll apply whether you're doing AR versus customer records, AP versus customer records, it doesn't matter. Anytime the third party has done something that you have not done, then you're going to have to do it in your accounting system. Here, anytime the physical count has done something or counted something that you don't know about, then it needs to be updated on the GL inventory, and so on. And then lastly, let me just mention something. Not all reconciliations are about finding these items here, okay? It's interesting that we find that there's one thing that the other person or the other party did that we did not. That's the nature of the reconciliation. But there's also, in accounting, we also use a whole bunch of exception reports where what we're looking for is that situation where we have a reconciling item and that tells us something. That's an exception. It's not like we're going to go in there and do a specific accounting for it. It's just that information is important to us. So I'll give you a quick example of that just so you can see what I'm saying. Payroll has information about who they pay on a weekly, bi-weekly, whatever period they did. So the payroll department pays and has a list of names. That list of names better be the same list of names that the human resource department has. So if you're looking for an exception report, which basically resembles a reconciliation, then you run these reports and make sure that no name exists on payroll that is not on HR. And if there is one, then that's technically a reconciling item, right? It's something one side has that the other doesn't. Now, in terms of an exception report, the implication of that is that it allows us to see what is wrong. We're not going to go in there and do a classical reconciliation like we've done here, but it's nothing different. So if one name pops up and gets a check, this person is whoever, subject A, and all of a sudden subject A is not listed in the HR personnel, then that could be a red flag that exception, that reconciling subject A could be a red flag that maybe something is incorrect in terms of payroll. Because if HR does not have authorization for subject A, then we should not be seeing subject A there. Okay? So this concludes my video on reconciliations, and I want you to always think of them in this very simple way. And if you do, you're never going to get stuck, in my opinion, on doing a reconciliation.